Hi, I'm Peter Rose, founder of Longwood Currency Trading. I want to discuss the issues of FOREX large lot size entry, stuff that you'll run into when you're dealing with large lot size. What's large lot size? Probably 8 lots and up, something like that. You tend not to have to worry about it under that. If you have a large enough bank to trade, 3, 5 lots, something like that, you're probably still going to be trading all in, all out. But when you get to the larger lot sizes, 8 lots and up, something like that, I consider that to be large lot size, because I'm pushing $80,000 to $100,000 behind that. So okay, because I'm not trading at 500 to 1, I'm trading at 10 to 1 as part of my risk management. So if you want to trade at 500 to 1, as soon as you run into that 8 or 10 lot position, there are some concerns that you need to be aware of. In trading large lot size positions, I usually break the thing up into what I call a building phase and then a staging in phase. The building in phase takes place as you build a position that you'd be happy with if you had to jump out at 3 to 5 pips. In other words, you'd make enough money, you'd make $300 or something like that. I mean, if you have an $80 a pip capability, you're trading 8 lots, you're trading $80 a pip, and you make 3 lots, that's $240, pretty close to the $300 range. I mean, look, if you could do $300 a day, 5 days a week, it's $72,000 a year. So that's kind of a good point for someone who's trading large lot size to say, well, I made $300 today. Because if that's all you did, you'd be okay. Now, that might not be a very good return against your risk. If you divide, if you're trading like I am at 10 to 1, you divide $80,000 for 8 lots into a $300 return. That's probably not a real good return on that. But, and I don't know what that would be. Well, let's say it's 3 or 4/10%, whatever it is that you get. You say, well, it's only 0.3%. Well, yeah, but there's 200 trading days a year, so you're going to make 0.3%, 200 times a year. You do the math on that and move the decimal point, and you've still got some pretty good dollar value, even though the percentage is down. It's okay maybe to have a 10 or 15 lot position running in profit, and then things go wrong and it starts slipping back toward your average position value, and you go, I'm going to get out at $300. The issue here is if you're trading 3 lots and it goes up and it comes back and you've got 1 pip to go, you make $30. So from a percentage standpoint, I guess you're the same as far as your pips go and the amount of size to the bank and all that other stuff. But with that 3 lots, you don't want to break that up into a 1 and a 1 and then stage in another one after that to get your 3 lots. Because if you had to bail out with that 1 lot at 3 pips, you're not making any money. You make $30. So that's why when you're dealing with the 3 to 5, up to 3 to 5 lots, or maybe you go as high as 8, but I'd suggest maybe at 5 lots you start thinking about moving up into building positions and then staging from there. But with your larger lot size positions, if you think you're going to have a 10 lot capable position, you got $100,000 behind you, or 60,000, or whatever you get. I don't know. If you're trading at 200 to 1 and it goes bad against you, you're going to lose too much of your bank to be able to do that more than 2 or 3 times, and then you're at the woods. So I don't know what to tell you. But if you have a 10 lot capable position and you go in with 10 lots at your opening and you get it wrong with a 10 pip stop, you're $1,000 out. Now, what happens if you're in a statistical losing situation like I've been in the last few days? Things haven't gone right because I'm loading too many lots of my bank up front. And I'm not necessarily starting with that, but as I go into a position, maybe I'll go into the position with 3 lots. It'll go in my favor. And it's going really good, so I'll bang another 3. And it's going in my favor, and I'll bang another 3. And it goes against me, and it comes up to my average position value. So I'm a 0 value position on 9 lots. And then it goes 10 pips against me, just like that, boom. Because sometimes on these entries in high volatility situations following an economic release or something like that, you'll get a good momentum movement in the direction that you need it to go in. But because Forex is a zero-sum game, 50% of the people are wrong, and they're going to be bailing out. And if you have 50% that are bailing out, then it's going to move the price back 50% from where it came from. It has nothing to do with fucking Fibonacci numbers. It's just it's called order flow. And so you have a position that you've put those 9 lots in over the last 15 pips, let's say, and you're getting ready to fire off that next one, and all of a sudden you get one of these, everybody bails out of their bad positions, and you go back 7, 8, 9 pips on a 9 lot, and you're 9 pips over your average position value, and now you're you're $900 underwater, and you're going, holy shit, I went in with 3 to risk a 3 lot at 10 or $300, and now I've got a 9 or $900 or $1,000 loss. So what am I going to do? And by the time you think about that, that price is it's like throwing a ball against the wall. It's going to come back past you here and bounce off that wall, and finally it'll be reasonable. So you may have experienced a 15 or 20 pip drop, and then there was a stagnation, and then another 15 pip drop, which is where I got in, and you've got your 9 lots, and that thing is going to go back 20 pips instead of 15, and now you're $2,000 underwater, and it happens in 2 seconds. And you say, well, why aren't you putting in your stops and all that other stuff? Because when you're moving in high volatility situations, which is what you like, and you have a large lot size, you can't commit that entire lot size right away, because you don't know when the retracement is going to go. If you take a 10 lot and throw it in there, and you've got a lot of weak players that are absorbing that, everybody's going to be bailing out. So you're going to chew yourself just a little bit. You won't be playing against the institutional traders. In that case, you're playing against the frantic retail traders, which are about 5-8% of the market right now. $6.6 trillion. We used to be 10% of the market. We're now 15% of the market. We're not that anymore, because it's gone from, when I started trading currencies in 2007, 3.4 trillion, and now it's 6.6 trillion. So we went from 15% of the market to maybe 5 or 8% of the market today at 6.6 trillion. So the retail trade, the institutional traders, they've taken their positions for their clients. They're not going to screw around during an NFP. They're not trying to clip 5 points with $700 or $800 million client order. They're going to sit on the sidelines. It's the retail traders that are doing all this stuff. So if you get involved and you're playing in the pig pen with the pigs, you're going to get trampled, because the pigs like it. They like losing, and you're just going to get swept up into that. So you can't go in and say, oh, this thing is really moving. It's gone 15 pips, and I'm going to drop a 10 lot on there. I don't think you want to do that. I think you want to go in at 3 and then add 3 and then add 3. Well, you can't do that. If you're going to do that every 3 pips, your average position value is tracking so close to where the current value is that anything is going to take you out, and it's going to scare you. It'll take you out, and you'll lose $600-800, and maybe it continues to go further. You say, well, I'm glad I got out with $800, but you didn't size the entries correctly so that there was enough space between where your last entry was and the average position value. And so that's the large lot size entry issue that we have to concern ourselves with if you're going to play in this market. Now, it just isn't an NFP or a producer price index economic release that can cause these gyrations, because once you get a little further along in the day from where the primary pair trading time frame is, you are more retail traders then. So you have to be aware that although the currency market is inordinately liquid, and there are, I mean, even if the retail traders are only 5% of that $6.6 trillion, you take 5% of $6.6 trillion, $6.7 trillion, and it's still a lot of money being thrown around out there. So yeah, you have to be very, very careful of what you're doing. Well, you might say, well, I want to do that same thing with my 3-lot. I've got a 3-lot position. Maybe I should protect it by doing 1 and 1. I'm not going to get into it in detail. I personally don't think that's the way that you should be trading, and there are many reasons for that. And I suggest that you don't do that, because then you're trading for dollars instead of trading for pips. That's the basic advice that I give to folks that are studying under my guidance or my thoughts and ideas and things. Just be aware that as you're trading and moving up in your position size bank, that you're capable of trading larger lot sizes, that your entry issues become more complicated. I have 4 conditions for my entry rule, but they don't include the size of the lot positions that you have, because those rules are up in my framework. You know, I have entry analysis, position management, and exit methodology. Those are the 3 phases of the life cycle of a currency position that I've identified in many of my previous videos. Each one of those phases is a problem to solve. Overriding the life cycle of the currency position is a framework of rules. Are you using a static stop? Are you using a percentage of bank? Are you using a structural basis for your entry stop? If you have a certain large lot size position, how many lots are you going to use to build? And then what's your distancing between your staging positions? Those are not things that you want to figure out in real time, and those are issues that you don't want to cloud with your general problem solution rules, because they are things that happen that you need static rules for and not conditional based rules. And you know, that's what I teach in my courses. I can't get into it in a 10-minute video. So just be aware of, as you're moving to the larger lot sizes, you can't just jump, oh, I'm trading 5 lots a day, I got a windfall, I got more money in my bank now, and I'm going to go and I'm going to trade 8 lots. You better think twice about all in, all out at 8 lots, and you better think twice about how you're going to start staging those larger lot size positions into your build. Because remember, if you're trading a 5-lot capable position in the beginning and all in, all out, and now you've got 10 lots that you want to build, you may have a 5-lot position in the first 8 pips of profit, and that thing will swing against you, and now you're losing more than your 5-pip lot normal stuff that you were doing before, because you've probably ticked off the next level and you may be 8 lots in there at that particular time. So you have to be really careful about, well, I guess the thing you need to be most aware of is, where is the average position value in relationship to the current price? Be aware of that. That's your first thing that you need to consider when you're starting to trade larger lot size positions in Forex. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.